Hey guys, James here with Waterford Business Solutions. And as we close out the year, we're coming up on a vital timeline that, while you should be taking care of it throughout the year, it's definitely something we want to really pay attention to at the end of the year and try to get some estimated tax payments in to the IRS and your state and local governments, depending on if you owe income taxes to them. Estimated tax payments are really a prepayment. Anytime that you are running a business, anytime that you own a business, you've got income that you're making that is not being automatically taxed. As an employee, generally you're going to be receiving a paycheck. Again, as an employee, not a contractor. And in that paycheck, your employer is going to withhold taxes from you, withhold income taxes from you. Those income taxes that are being withheld end up being paid in generally on a monthly basis, sometimes on a weekly basis, depending on how much tax liability your employer may be carrying, so that you are regularly paying in for your tax liability. So as an employee, you are consistently paying in a timely basis for any tax liability that you have. However, when we move to a situation of you being a business owner, operating a business, managing a business, doing something like that, it becomes a completely different story because throughout the year, you are earning this money. You are getting in income and everything like that from net profit that you are holding. And that is a key word there, is net profitability. That net profitability, which is going to be any sales, any income that you have, minus any and all tax deductible expenses, is taxable as normal income. Now, depending on your business structure, whether you're a sole proprietor, an LLC, a partnership, an S Corp, a C Corp, will depend on the tax rates that you have and the taxes you have to pay. It all depends on different states, it all depends on different locations, it all depends on so many different things here. So today I want to kind of talk with us and go through what is the different options or what are the different things that we have to do here for estimated taxes. We're going to primarily focus on thinking about and working with federal taxes because unfortunately we've got over 50 states. I can't do a video in a timely manner at least that's going to cover taxes and estimated taxes for each and every state because each one is different. Most states are going to follow a fairly similar regulation on the federal government where you're going to have quarterly payments, but there are some states that either don't have any income taxes or they don't have income taxes, but they have business taxes depending on your business income and everything like that. So in future, we might do some videos focusing a little bit more on state-specific taxes, but right now this video is primarily going to focus on federal income taxes and federal self-employment taxes. It's important to remember, if you are anything other than an S Corp or a C Corp, you are going to be taxed both for income taxes on anything that the business brings in, along with self-employment taxes on what the business brings in. Self-employment taxes are a flat rate. That is basically a flat percentage that you are going to be paying. And that flat percentage doesn't matter any tax deductions, anything like that. Your net profit is multiplied by this flat rate to come up with your self-employment taxes. Income taxes, on the other hand, are bracketed. Income taxes can also be affected by tax deductions, such as child tax credits, such as energy efficiency credits, such as many other credits or personal deductions that are out there based off of your company's structure and how it flows over onto your personal tax return. This is another important thing to remember, is that these business taxes, or these taxes that you're paying for your business, aren't per se taxes the business owes. Any taxes, unless you are a C Corp, that a business is paying is really a personal tax liability, because whenever you own a business that is not a C Corp, all of that income flows from the business tax return to your personal tax return and becomes a personal tax liability. Now, with that being the case, that means on everything other than self-employment taxes, you're able to use personal tax deductions to reduce that taxable income after all business expenses, after all business deductions and everything there, to further go ahead and reduce any taxes on income tax that you owe. But this does not reduce, this does not affect your self-employment taxes. We're going to dive deeper in future into kind of understanding taxes, understanding income versus self-employment taxes, everything like that. But as it stands right now, this is kind of a good crash course overview while we get into talking about estimated taxes. Moving on to this real subject here about estimated taxes. Estimated taxes are pretty much a requirement. With the federal government and with the IRS, you're required to pay in your tax liability in a timely manner. Now, like we talked about at the beginning, if you are an employee, your employer is going ahead and paying in on a monthly basis generally for your taxes. That is your timely manner, and they're doing it for you automatically. But if you've got income, and this isn't just for businesses, this could be selling a house. This could go ahead and be changing, or this could be selling stocks, trading stocks, being a 1099 contractor, not even owning a business. We speak specifically on businesses because that's the majority of our clients. But any income that you're making outside of basically W-2 income or income that's being taxed automatically, you need to pay in a timely manner. So if you have an IRA here by chance that you are taking draws from and they're not withholding taxes from you automatically, that's going to create some issues there and going to cause a undertaxation of everything, and you could have penalties and interest. And that's why these quarterly tax payments exist. Every quarter, April 15th, June 15th, September 15th, and January 15th, that's the standard days that the IRS has set. It's been that way for the past 3 to 4 years. That could always change. Please keep that in mind. We're looking at the same thing here for 2025, so don't expect any major change there. But those are the dates that we have to pay these in. The IRS requires us to pay in an estimated payment, a reasonable payment, based off of the amount of money that you owe taxes on. So we have to take a look on a quarterly basis and say, okay, this is how much money that I have earned throughout this quarter, and this would be my tax burden on that money. Now, we'll talk in a minute about how we kind of figure out that tax burden, but that has to be done every single quarter. If we don't do that, and this is why we want to do this, because so many clients come to me, they're like, I've never done this before. Why do I have to do this? I'll just pay it at the end of the year. That's fine. You can do that, but you're going to pay more in taxes. And that's the important thing to understand. You're not going to get arrested. You're not going to go to jail. You're not going to get sued if you don't make these estimated tax payments. What's going to happen is you're going to pay penalties and interest on the money you didn't pay. And while for $1,000, $10,000, maybe even $20,000, that's not going to be bad, but it's going to be a potential extra $500,000, $1,000. I've even seen for $20,000, it's been north of $1,000 in taxes that you have to pay at the end of the year. So why are we going to defer what you're going to have to pay either way when you're going to have to pay more for this in the long run? That's the cold hard truth of everything is if you go ahead and do this, if you go ahead and make these estimated payments, in the long run, while you don't have that money today, you're saving money down the line and you're saving money in future there. With that, that's why we want to do estimated taxes. Now, Estimated taxes are very finicky, especially for business owners, and more specifically for the people in our field, because the people that we work with, contractors, general contractors, builders, they don't have a consistent, there's not a straight line of, okay, you're going to make X amount every single month. We can't really do that. There's curves. Our HVAC and plumbing technicians, they're going to be busier as we get into May, June, July, but they're going to be slow in January, February, and September, October. Or if they're in a colder climate, they're going to be slower in May, June, July, but busier in November, December. So it's really hard because there's this ebb and flow of what's going on. So there's two kind of ways that we can do estimated tax payments. The first is straight up saying, okay, let's take a look from January to April, or excuse me, January to March. How much net profit do I have? And then we figure out what your tax burden on that would be. Now, we can either figure that tax burden off of using your last year's tax return and saying, okay, your tax burden for last year was X percentage. Any tax return should tell you exactly what that is going to be. And you can just multiply that net profit by that tax burden. Or if you're smart enough, if you have enough knowledge, or if you're working with an accountant, they can go ahead and take a look at all of your specific situations to say, okay, well, based off of this income, based off of how many kids you have, based off of deductions, personal deductions you might have, based off of W-2 income or other income you might have, you're going to be lower or higher this year and come up with a tax burden. That takes a lot more thought, that takes a lot more planning, because there's so many more factors in there that we are having to take a look at. So it's important to remember there's a reason that you partner with an accountant. There's a reason that you partner with a financial advisor. There's a reason you partner with a tax person, because their job isn't just to do your tax return for you. And if that's why you have an accountant, if that's the type of accountant you have, you might want to look elsewhere. Their job is not just to do your tax return. Their job is to help you save money on taxes and to help you plan for taxes. So they should be willing, and they should be sitting down with you on a quarterly basis to take a look and say, okay, this is how much you need to pay in so that you don't get that big surprise bill at the end of the year. Now, this is going off of how much you're owing or how much you're making each quarter. The better way to do it, and the more complicated way, which there is software out there to do this, but it's not generally consumer grade software. It's software that accountants are going to have that you have to use there. But there is software out there that you can go ahead and utilize. And I'll tell you right now, we personally, while I can figure out stuff, I can use notes, I can use calculation spreadsheets to do this. Honestly, for a time saver and for the accuracy that I get out of it, we use a program called Tax Planner Pro. You should be able to go and get that yourself and hook up your QuickBooks, hook up your accounting software to it, hook up and put in all the personal information that you need to fill out there, and it can spit out numbers. The benefit of using a program like this is it takes a look at historical data and it takes a look at current data. So instead of just saying, okay, well, based off of what we did here in Q1 or what we did here in Q2, it's taking a look and saying, okay, based off of Q1 and what you did for Q2 through 4 of the prior year, this is going to be your total tax liability. And it updates monthly, it changes monthly based off of your current activity compared to historical activity. And you can make modifications if you think you're going to be doing better, if you think you're going to be doing worse. We can make some minor modifications there. But with that being the case, it's going to spit out a number that tells you exactly how much your estimated end of year tax liability is. Now, is this going to be 100% accurate? No. You might owe a few dollars more. You might get a few dollars refund. And it's also important to remember we're going off of historical activity here. When we are dealing with and when we're talking about historical activity, so much can change. I take a look at this past year for my clients. We had a decently good summer. Most clients did better year over year during the summer, but their Q1 and their September, October has generally been worse than where they were in prior years. So they're averaging slightly better or worse than where they were last year. So where our initial projections were for Q1 are over on several clients, and we're skipping or reducing some payments and everything here because of the fact that they're not performing as they historically have. So whenever we're talking estimating taxes, whenever we're trying to put in an estimated tax based off of really a ton of data factors, it's important to remember there's so many variables that even a trained person, even a skilled person, is going to struggle with doing it. Now, long term, when it comes to estimating taxes, anytime you get a tax return from anyone, it should say on that tax return, hey, here are your minimum estimated tax payments that you should make. When you get that, that is the minimum you need to do every single quarter to avoid penalties and interest. So as long as you do that, you're not going to get charged penalties and interest. You're not going to have to pay additional amounts. You're not going to have to do anything like that. But you may be underpaid or you may be overpaid. That's why I suggest and I recommend, rather than just going off of that, hey, based off of your last year, let's look at what's actually going on this year. Because so much, especially in business, changes year over year. So much modifies, so much gets changed because we don't know how you're going to do sales-wise. Or what if you sold a house last year that increased your tax liability? So using actual data based off of this year compared to that, hey, based off of last year, gets us more accurate to where your payment should be so that you're not overpaying as much or you're not underpaying as much. The number one thing that I hear from clients when they onboard with me, when they start working with me, when I start dealing with their taxes is, oh my God, I don't have a $20,000 tax bill in April, because we've been doing those estimated taxes, and instead of having one $20,000 tax bill, we've broken that up into $5,000 quarter bites where they can prepare for it a little bit better, save for it a little bit better, and not have this huge surprise because we're talking about it every single month, every single quarter, and planning out for it. Planning for taxes, planning through taxes, thinking through what is going on there is vital for a business owner. And I strongly recommend that you work with and you talk with a accountant, a CPA, an EA, someone that is going to help you do that. If your current person isn't doing that, talk with other people, find other people. If you need help with that, don't hesitate to reach out to us. We're happy to talk with you. We're happy to give you some ideas on estimated taxes. We're here to help small business owners, and we want to make sure that you are making the most of your money and planning as best as possible for what your future and what your tax liability would look like. You can give us a call at 864-351-0852 or shoot us an email at info@waterfordbusiness.com, and we'll be happy to assist you and talk you through any and all issues that you may be having there and see how we can make you a better tax prepared business owner, a better tax prepared person, so that tax season is not as much of a stressor for you. Other than that, I invite you to please go ahead, like, share, comment, and subscribe and follow us here on YouTube to get more information just like this on taxes, but so many other financial discussions that we have. We want to provide you this information so that you can understand, grow, and get better in your business and in your personal finances. So go ahead and hit that subscribe button, turn on notifications, and share this with anyone that you think this might help. Until next time, thank you for joining us, and we'll be back next week.